But for me, I really hone in and I continue to look and stay up to date on my local market. I see updates through all those sites that I just mentioned, just seeing houses, because I actually own a lot of single family, so I like to see the trends. So I'll use like Zillow and Realtor.com to see what data that they're putting out, because remember, they have all these houses for sale and they have all these houses that go pending and under contract, and so they have all this data. They're a data aggregator, right? And they're able to provide that data for free for us. And so I look up on there. You can also use sites, like if you're a realtor, you can use, MLS, and the local realtor board puts out, weekly and monthly reports on homes sold, pending, under contract, and medium home price and stuff like that. So you can do a combination, a little bit of everything. But if you're watching this and you're not a realtor, I would just say go on Realtor.com. And you can go over any market, any zip code, and get data for free. It's packaged right there for you for free. Pretty accurate, I would say, too.
How important is proximity to public transportation, school, or employment hubs when you're investing in a property?
I mean, it's common sense, right? Like if I buy a property and it's in Cowtown and Horsetown, and there's one home every 5-6 miles, then that tells you like you probably should be buying that home as a buy and hold, right? You maybe can consider as like a fix and flip if the market dictates that, but like it's simple, right? Like you buy a home, you want to be in areas where there's population, where there's employment, right? If there's no employment around, how are people going to go to work and pay you your rent every single month, or whatever you're doing as an exit strategy? So being around, it doesn't have to be, you don't have to be next to a bus stop per se, but you want to be in an area where there's other homes, there's other people, there's employers, there's things that are going on. If you're in a town where there ain't no traffic, there ain't no stoplights, then you shouldn't be investing in there. I like to be in big cities, and I also like to be in secondary markets that are near big cities as well, that are phenomenal. But again, I want to look at what's the job growth. That goes back to what I keep saying, economics. What are the economics of that? Is the population growing for the last 10 years? Is the employment rate growing for the last 10 years? Right? Look at these metrics to see what they're doing. And you can get, good data, and that way can tell you like, hey, you're in a good market and stuff like that. But you can't go wrong buying in a big major metro city, like, Dallas, Texas, you got Orlando, you got Tampa, you got these big core markets, Arizona, Scottsdale, Arizona, Phoenix. These are great markets for investments. These markets are growing, they're innovating constantly. So you can't go wrong buying a house in there. Now, one thing I will say though, and certain investors will buy in certain type of, like I personally like I would say like C+ to B- neighborhoods.
Yeah.
Right? I don't want my car to be jacked up on cinder blocks when I come out of the house, right? I want people and my tenants to feel safe and secure wherever they're renting from me as well. And that makes a big difference. Now, there are certain investors that focus on the flip side of that, where they're okay with like the D- neighborhoods and stuff like that. But me personally, I prefer, a little bit, that mid-class, neighborhood roughly, because you get a different type of clientele. You get somebody who's a little bit more sophisticated. You get a little bit someone who's more serious about their financial picture, and they're just more responsible overall, So neighborhoods, I like to be in neighborhoods that are, I would say like C, C or above, B-. I'm in some B, I'm in some A neighborhoods as well,
But it's like you want to make sure that, any client who sees the property knows that they're in a safe neighborhood, and depending on the
Yeah, I
client,
mean, if you got a 3-2, you got a 4-2, most likely somebody like a family is going to want to rent it from you, right? It's family with kids, they have kids, then they're going to want to feel safe and secure there. So
how do you calculate a break-even point for a potential investment?
Good question. So how do you calculate a break-even point
Yes.
for a potential investment? So what you want to do is when you're underwriting your investment, first of all, you need to know and have a clear understanding of what type of exit strategy you're going to do when you acquire that piece of property. Is it going to be a buy and hold, like a long-term traditional buy and hold, which everybody's familiar with, right? That's where Susie Q is renting the property from the landlord at 123 Main Street, and they pay every single month, kind of like what you're doing, right? Well, not kind of, that's what you're doing. That's
Absolutely.
what we call, in the real estate world, we call that long-term rental, right?
Yes.
Then you have all these other exit strategies like Airbnb. You have now co-living, right? Those are some common ones. You have midterm rentals. These are all different common ones, right? But let's just use, for simplicity standpoint, let's talk about long-term rental. If I'm a landlord and I own a long-term rental, which I'm not a big fan of, right?